Okay, we continue with the next video. It's on the unearned revenue. What is unearned revenue? Unearned revenue is a situation where your client place order. So they place order. For example, they come and see you. Okay, ask you to complete a service, for example, painting a building. Okay. So when they book, they also paid in advance. Okay, when they make the payment, okay, the payment you receive is not your revenue yet. You have to record as unearned revenue, okay, on that particular day. When are you going to recognize as revenue? You're going to recognize as revenue when you have completed the services, or when you delivered your service. Okay, once you completed the painting, the whole building, then you can recognize as earned revenue. Okay, right. So the cash you receive as advance is not a revenue, it is a liability. So what we have to record here is debit cash, credit, unearned revenue. In this case, this example is unearned rent. So on 1st December. What will happen at the end of the month? This is journal entry. This is the account. The account shows that your cash is 360 debit, unearned revenue credit. Okay. So at the end of the period, you have to do the adjustment. The rent payment is for 3 months. 360 ringgit for 3 months. 1 month is 120. So you have to do the adjustment. Okay. So on 31st December, what you have to write on the journal entry is debit unearned revenue. In this case, rent 120, debit credit revenue 120. So the description is adjustment for unearned revenue. Now the T account with like this. So you have to adjust the unearned revenue. Previously, we have paid, or we have received 360, and we recorded as unearned revenue. And at the end of the month, we have to adjust debit unearned revenue and credit revenue. This is earned revenue, right? So another 240 is meant for January and February rent payment. Okay. Okay. Now let's see what's the impact of omitting adjusting entries for unearned revenue. If we did not provide the adjustment for unearned revenue, obviously our revenue are understated. We did not declare our revenue if we did not record the or we did not provide adjusting entry for unearned revenue. Okay, and our net income is also understated. Okay, so you can see from the statement of profit and loss. Okay, it's understated both for revenue, and also overstated of liabilities, because the unearned revenue is the liability. Okay, if we did not record an adjusting entry, we did not actually got the true picture of the revenue that we should earn. Okay, let's see the exercise. Okay, exercise given here. The balance of unearned fees account before adjustment at the end of the year is 44,900. Journal entry generalize the adjusting entry required if the amount of interest unearned, the amount of unearned fees at the end of the year is 22,900. Given to you, this is the figure before adjustment, 44,900. Okay, we have to generalize the adjustment entry if the amount of unearned interest is 22,300. So we have to deduct 44,900 from 22,300. This is the figure. So the unearned fees we have to debit and credit the fees earned. So it means that the fees that we can declare or we have to record is only 22,600. Okay, let's see the accrued revenues. Unrecorded revenues that have been earned for which cash has yet to be received. We haven't received cash yet. Okay, in simple word, we have performed the services or we have sell the product to the client. Okay, so once we perform these services, we have to record the revenue even though we haven't received any money, any payment. Okay, you mentioned that revenues were not recorded, so no journal entries originally. So we have to record the journal entry. For example, in this case, the example given is the revenue is 500 ringgit. Okay, so debit accounts receivable and credit accounts revenue. Okay, so these are the journal entries and these are the accounts. Accounts receivable, debit side 500, and you have to record revenue. The revenue accounts, credit 500 and record as accounts receivable here. Right. Debit account receivable, credit, fees, and okay. In this example, Net Solutions signed an agreement with Dharma Company on December 15 to provide services at the rate of 20 ringgit per hour. Okay. On December 31st, Net Solution has provided 25 hours of services. So what we have to do, we have to record the revenue for the services. Okay, Net Solution has provided services at the rate of 25 ringgit per hour for 25 hours. Okay, so we have to do some calculation. 25 hours times 20 ringgit per hour. Okay, and the total revenue is 500 ringgit. So debit accounts receivable 500, credit fees earned 500. Okay, this is the accounts receivable, debit 500. This is fees earned, credit 500. Okay, the same if we did not record the adjusting entry, we understated our revenue. We did not declare revenue amounting to 500 ringgit. So our net income are understated, our assets are understated, as well as our owner equity. So the impact is huge if you did not record the adjusting entry. Okay, we will proceed with another video of this.